Hello, friends. Good afternoon. Now, I would like to welcome you to lecture series 8 of Unit 6 Mutual Funds. Now, today's discussion point would be forfeiting services of financial institutions. What is forfeiting meaning, special characteristics present, and the special characteristics process of forfeiting, advantages and difference between forfeiting and factoring. Now, we have already seen our previous class what the factoring is. Factoring emerges basically because of the credit sales made by the seller to the buyer, or goods sent on credit basis. If the seller requires the liquidity of the credit sales, which he has received the bills receivables as a guarantee of the repayment from the seller, from the buyer, and those bills payment receivables are deposited with the factoring, and the amount is encashed from the factoring organizations, that is financial institution called factors. And after the maturity, as the case may be, if it is recourse and non-recourse contracts, accordingly the bills are settled. If it is a recourse, then the financial institution will recollect the money from the bills from the seller of the goods, that is the client, uh, without interfering into the transactions of buyer and seller. In case of recourse bill, in case of non-recourse bill, we have already seen that the buyer is that the factoring company is going to collect the money on behalf of the seller, that is the customer, that is the client, from the customer, that is the purchaser on credit goods. So the legal action will be initiated for the dishonor of the bills or for the bad debts, and money is recovered from the what you call as a credit seller, that's a credit buyer. So now the forfeiting transaction is an extension of this factoring. Forfeiting means in Kannada muttugolu ಹಾಕಿಕೊಳ್ಳೋದು. Muttugolu means collecting the rights of that particular bills receivables exclusively and entering into a different kind of a contract with the customer who has defaulted to pay the money, where the customer is giving an additional contract, separate contract, that the defaulted customer who is unable to pay the real bills payables on which are with the factoring company, where the another transaction is entered into at a different interest rate, where the factoring company forfeits the rights of the what you call as the bills receivables, and gives a long term loan facility to the to the uh, purchaser, credit purchaser, and collects that money on a different in a long term way, monthly, quarterly, or something like that. The price is collected from him. So the forfeiting organization, which was earlier a factoring, becomes a forfeiting organization and settle the transaction. But one important thing is this forfeiting business, the forfeiting contract is for overseas transactions. That is for the foreign transactions, not within the country. It is foreign transaction only, where the forfeiting can be, factoring can be converted into forfeiting, a new kind of business opportunity. Now let us understand the meaning of forfeiting. Forfeiting, or a medium term capital goods financing, means selling a bill of exchange at a discounted to a third party by the what you call as bills receivable, that is the receiver, that is the seller. The forfeiter, who collects the payments from an essentially overseas customer through a collateral banks, and assuming the underlying responsibility of exporters, and simultaneously providing the trade finance for imports by converting a short term into long term medium term one. A simple example that I can give you on understanding the forfeiting. Now, in this case of forfeiting business, suppose the Patanjali company has exported a honey to Nectar company in USA, to a Nectar company in USA. The trade deal is for 100 crores. Say, for example, sorry, 10 crores. Trade deal is for 10 crores. Now the nectar company has purchased the goods on credit basis. That is, the Patanjali company has sold the goods on credit basis. So accordingly, the buyer has to issue the bills receivables to the that is, nectar company has to issue the bills receivable against the credit purchase to Patanjali company. And suppose the Patanjali company is in need of finance before 1 year. The term of that credit sale is for 1 year. Before the Patanjali company is in need of liquidity of funds, it will deposit that money with the HDFC factoring company. An example, HDFC factoring company. The 10 crore is encashed, discounted. Bills receivables are discounted. This is called a forfeiting business. This is called, sorry, factoring business. After the maturity of the time, the goods are collected from the proceeds are collected from the nectar company by the HDFC if it is a recourse, non-recourse transaction. If it is a recourse transaction, in this case, the Patanjali company has to pay the money and gets the bills of exchange in their hands, and then it has to collect the money from the nectar company. So this is the factoring activity. But the forfeiting is in the similar way. It is an extension part of forfeiting. In this case, what happens, the nectar company, when it issues the bills receivables to the Patanjali company will sell the total bills receivables, does not discount it. It sells the total what you call as bills receivables to the HDFC company. Now HDFC company, what it will do is it will convert that bills receivables into long term financial assistance to nectar company. Now the nectar company has to appoint a banker in their country, in USA. The banker will discount the bill of that particular nectar company by receiving the money, and sorry, the banker will give a guarantee of the nectar company, acts as a guarantor to the HDFC company in India. So HDFC company, against the guarantee of the say for example, the USA Bank of nectar company will issue the financial advances. For example, this is a 10 crore rupees bill. 10 crore rupees will be collected not within the 6 months, where the nectar company can apply for the loan advances through by giving a guarantee to this HDFC company. In this case, HDFC company will withhold that bills receivables, and the rights of that bills receivable collection is converted into long term business opportunity, say for example 3 years or 4 years. Then the nectar company has to pay monthly installments or quarterly or yearly that particular EMI of the 10 crore rupees to the nectar to the HDFC company. So now HDFC company gets the rights of that particular bills receivables, that is what you call as the credit receivables rights for 5 years or 10 years, something like this, for the long term period. And during that particular period, with the interest rates on EMI, it is going to collect the money from the nectar company. So this activity is called as forfeiting. Actually it was a credit sale, and the rights of collection of bills receivable was lying with the Patanjali company, but HDFC has taken that rights and converted into forfeiting, and forfeits that particular what you call as bills receivable transactions, and enters into a new long term financial services to the foreign company, that is a nectar company. So this is an example of forfeiting. This is called forfeiting. Now let us understand what are the steps involved in forfeiting, like the steps what we have already seen in the uh, factoring. The forfeiting steps remains the same like this one. Forfeiter commits to purchase the deal from the exporter. Now the exporter is Patanjali, because he is exporting the honey on a credit basis to nectar company. So now forfeiter commits to purchase the deal from the exporter. So now the exporter commercial contract between the exporter and the importer happens on the credit basis. The commercial company happens. Delivery of the goods happens from the Patanjali company to the nectar company, that is the seller to the buyer. After the delivery of the goods, the A bank gives the guarantee. The bank of the Nectar company gives the guarantee to HDFC company in India for the repayment of the money in future dates. In that, not in that bills receivable time, it is a short term one for the long term. Importer hands over the documents to exporter. Now all the documents of the goods, credit goods, are handed over from the importer to the exporter. Exporter is a, what you call as, in India, that is the honey exporter, that is Patanjali. Nectar company gives the all the documents of the goods received on credit basis to the exporter. Then exporter delivers the documents to the forfeiting. That is the, earlier it was a what you call as a factor company. Now it is a forfeiter to that HDFC company. Now HDFC company is a financial institution acting like a forfeiter for the documents are received from them. When the documents of guarantee and loans advances and the sale transaction amount is received from the HDFC company, forfeiter pays a cash without recourse to the, that is non-recourse to the exporter. For exporter, it pays the total bill of the money. That is, if it's 10 crore rupees, 10 crore rupees is paid to the what you call as uh, uh, Patanjali company, and takes the total rights of that particular transaction. Then forfeiter represent, that is, presents documents to bank at the maturity for payment to that particular bank. And now what happens, the loans and advances are now given by the HDFC to Nectar company for a specific period of say 2 years, 3 years, like that. After the maturity of that particular time, as the banker of the Nectar company in USA is the guarantor, now the HDFC company will represent all the documents of the loan transactions to the bank. Now the importer repays the bank at maturity in their country, and bank repays the forfeiter at the maturity. Like that, maturity, that contracts say that the forfeiting business will come to uh, an end. Now, forfeiture is a financial service. Forfeiting is a financial services provided to the importers of the foreign company for additional time gap for the credit purchases. So, forfeiting business is gaining a more momentum as it is giving a more opportunity for the financial institutions to earn additional foreign businesses. So, this is what the process of forfeiting. Now, looking at the point, forfeiting and for the factoring found to be same, but forfeiting is different and factoring is different. In factoring, only the seller is given the liquidity part for helping, whereas in case of the forfeiting transaction, it is taken as a business opportunity by the financial institution and earns additional long-term credit service business out of the foreign transactions. So these are all the points connected with it. Now we will study the special characteristics of this forfeiting business, how that forfeiting business is having a special characteristics. Now, looking into that special characteristics, you can understand the first important character is forfeiting is done on a non-recourse basis, where the non-recourse means the total risk of collection of the debts lies with the financial institution like a forfeiter, but not lies with the exporter or seller of the goods on credit basis. Now, second one is used for international transactions only. So now this business is only pertaining to international transactions. It is not for the domestic transactions. It is converting a short-term finance to long-term finance facility where the bills receivables normally allows for a span of 6 months, 3 months to maximum of 12 months. That is 1 year. Within 1 year, the bills receivables will get settled. But in this case, it is extended version of that where it is given the long-term or medium-term loan facility by the financial institution to the foreign importers. The fourth one is there are four parties involved in the transaction of forfeiting transaction. One is the client, that is the credit what is exporter, who is selling the goods on credit basis to the foreign company. Second one is the customer, that is the foreign buyer, that is the importer of the foreign country. And third one is the forfeiter, that is the financial institutions established in the country, that is the forfeiting financial institution. Then guarantor for customers staying abroad, that is the banker for the foreign importer, banker of the foreign importer, who acts as a guarantor for long term loan business. Then forfeiting is an extension of factoring. Factoring is for only for 4 months, only for within a year, whereas factoring is forfeiting is more than that. The client is relieved from risk of bad debts in case of forfeiting business totally. Even in recourse, non-recourse bill transaction also is relieved. But in this case, he is totally relieved because once the credit sale is made, but immediately after the receipt of the documents, the credit sale problem is resolved with the exporter, because he will collect the whole price of that particular credit transaction from the financial institution is a who is acting as a forfeiter. So he is relieved from all the bad debts. These are the special characteristics. Now, what are the advantages of forfeiting? Forfeiting eliminates risks like risk of the total exporter, that is political risk, transfer, and commercial risk, because whole of the risk will lies with now the forfeiter, the financial institution. Now, improves cash flow by providing a ready liquidity against transactional documents. Now, improves the cash flow by providing a ready liquidity against the especially advantage for the exporting company, that liquidity happens on the spot. He does not require to wait for a long time, that is for years together. For the importer will be converting that transaction to forfeiting transaction. Then forfeiting allows you to discount long-term debts too. So it helps to discount the long-term debts also, enhances competitive advantages. Because of this, importers can import large amount of goods from our country, basically because of this forfeiting business, and it helps to competitive advantage. Increase the speed and simplicity of the transactions. Speed and the transactions are simple because the importer exporters of Indian country companies are relieved from the tension of credit sales, because it is taken over care by the forfeiting financial services, because they are having a legal wing and all kinds of facilities. So these are the basic advantages. Now, if you see the difference between forfeiting and factoring, they look to be same, but there is a lot of difference. In case of forfeiting, the entire value of the bill is discounted by the forfeiter with the financial institution. But in case of factoring, hardly 75 to 85% is discounted, and the remaining amount will be received from uh, the factoring company. After the receipt of the discounted money will be paid to the additional money will be paid to the forfeiter. So the discounting happens only to the tune of 85% to 90%, but not 100%. But in case of forfeiting, it is 100%, because the whole of the rights of the receivables is taken purchased by the financial institution. Now was acting like a forfeit, factoring now acts like a forfeiter. Involvement of availing bank, the availing bank involvement is there in the factoring. In the case of importing country, the importer is using the involvement of the availing bank. And in case of forfeiting, exporter factors assesses a credit worthiness, and based on that only he gives the credit. So total risk of analyzing the credit worthiness and the guarantee for the recovery is given by the credit seller to the forfeiter. But in case of in factoring company, so the guarantee is given by the credit seller to the factoring company. But in the case of forfeiting, the banker in the of the uh, importer is giving the guarantee. Now, the next one is purely a financial arrangement. Factoring is purely a financial arrangement, whereas, forfeiting is purely a financial arrangement. The basic idea is to earn the money out of financial services by the forfeiting company. But in case of factoring, also includes ledger administration, collection, etc. In this case, it acts as a representative of the what you call as the credit seller, the credit seller representative. On behalf of the seller, the forfeiting company is acting like a administrator, collector, like that, funds from the foreign company. Whereas factoring is a long-term financial service, whereas forfeiting is a long-term financial services, whereas factoring is a short-term financial services. The last one is exchange rate fluctuates are guarded against. Now the currency exchange rates are varying from time to time between the countries. For example, if you sell today the goods of 10 crore rupees to a foreigner, when the price of the dollar is say for example 100 rupees, after that particular transaction, if the price of the dollar increases 100 to 150 rupees, then automatically the receiver who is receiving the money, that is the credit seller, that is the exporter, has to receive a less money from the foreigner, because the dollars which are credited to the account are less because of the increase in the price of the what you call as dollar. But that particular problem is not there with the exporter now, because the whole risk of managing all that fluctuation lies with the forfeiter. That is one advantage. So exchange fluctuations are guarded against. Now here exchange rate fluctuations are not guarded in case of for factoring, because any change in the prices would be suffered or gained by the exporter in the case of non-recourse, sorry, in case of recourse transactions fluctuations. So these are the basic differences. Now in the examination, question will be asked normally, what is forfeiting? Discuss the difference between forfeiting and factoring. Or what is forfeiting? Discuss the uh, various stages or the procedures of forfeiting or advantages of forfeiting. Kindly prepare for the exam. Now I thank you for your patience, involvement and listening to the subject. Thank you. Thank you.